Hello and welcome to Chapter 1 of your Practice Test Academy CIMA F3 Financial Strategy course. I hope you're well and ready to go. Now in Chapter 1 we're going to be looking at the objectives of the organisation. The objectives, the fundamental objectives of the organisation, set the scene for the financial strategy of that organisation. And in this chapter we broadly distinguish between a for-profit entity and a not-for-profit entity and have a look at how those objectives differ and how that will impact on the financial strategy of the organisation. Also, practically in this chapter, we'll have a bit of a recap of some key financial ratios which come in, because organisations often express particularly their financial objectives in terms of achieving certain ratios. So, without further ado then, let's get started. Different organisations exist for different reasons, and the mission of the organisation, which we talk about much more in CIMA paper E3, explains why that organisation exists at all. We distinguish broadly on this course between profit-making entities, so those organisations exist principally, not only, but principally for the shareholders and are there to create wealth for those shareholders. And then we've got not-for-profit entities, which might include things like charities. It might include public sector organisations like state-run schools and hospitals. Those organisations don't exist to earn a profit, so in terms of measuring their performance, measuring profit means nothing to those organisations. So we'll have a look at an alternative there known as the value for money framework. Entities can either be incorporated or unincorporated. An incorporated entity means it's a separate legal entity from its owners. It's a company and that owns assets and can incur liabilities separate from its owners, as opposed to an unincorporated entity, which is just an activity of the owner. So it's indistinguishable, not separate from the owners. If an organisation is described as quoted, that means it's listed on a stock exchange, and that means a significant proportion of its shares are tradable and traded in the public domain, as opposed to unquoted, which are not on a stock exchange. Okay, so a principal stakeholder, particularly in a for-profit organisation, is a shareholder. But there are other stakeholders in organisations, and we need them all to participate. Otherwise, we won't have a functioning organisation at all. So, for example, shareholders might want to generate wealth, might want to become wealthy, but they can't achieve that unless they've got customers who are happy to buy from them, employees who are happy to work for them, suppliers who are happy to supply goods to them. So these stakeholders all need to be kept happy. And it's not always possible. The objectives can come into conflict with each other. And a particularly important conflict to be aware of is the conflict between the owners of a business and the directors of that business when there is a separation between the two. So if you've got shareholders who own shares, let's say through a stock exchange, the directors run the business on their behalf. And sometimes the objectives of those directors may not be aligned with the objectives of the shareholders. For example, they want a decent salary, low risk, stable business to manage. Shareholders, if their directors are paid too much, that's less dividend for them, and they may actually want a little bit of risk, because risk often implies return if it's well managed. So the concept of agency theory refers to the fact that we have this separation of ownership and control, and something known as the agency problem is where the objectives of the principals, being the shareholders, and their agents, the directors, when they diverge. Now that can be managed with things like external audit, reporting, for example, and the way in which you remunerate the directors being carefully thought out. Much more on that in paper P3. Now let's focus a little bit more on profit-making entities. So these organisations principally exist to maximise shareholder wealth, and that's the underlying objective behind the decisions we're going to be making. So when we're considering should we invest in a certain project, we're considering here, will it increase the wealth of the shareholders? That will typically be the overriding objective of the whole business. So that'll be the primary objective. The secondary objectives are the ones that support that, and that's things like keeping the employees happy, keeping the customers happy, keeping the suppliers happy, and what it is that they want in order to ultimately achieve a maximisation of shareholders' wealth. Now, in terms of measuring the performance of a for-profit business, shareholder wealth is typically measured in terms of net present value, the value of the shares. So a shareholder is made wealthier by capital gain and by income. So a relatively foolproof way of measuring the increase in shareholder wealth over a period is using something known as total shareholder return, which is the dividend that's been received, the cash that's been received over a period, the capital gain over a period, which is closing share price less opening share price, divided by opening share price to give us a percentage. And that measures it for us. That measures shareholder return, total shareholder return over a period. But we quite often want to look ahead and budget, for example, as to what the returns are going to be. So rather than look at trying predicting what closing share price is likely to be, we set other financial objectives for the organisation, which are a little bit indirect, but those financial objectives are designed such that if we achieve those objectives, we end up increasing shareholder wealth. So we express those often in terms of financial ratios that we'll talk about a little bit later on in the chapter. But those financial objectives should include considering things like the level of risk that the organisation is prepared to accept for the level of returns it thinks it's going to generate, how much credit it gives its suppliers and its customers as well, any limits they have in terms of government restrictions and finance providers limits. So quite often lenders will say you can only borrow up to so much and so on. But more detail on those as we go through. And like we said earlier, these will be underpinned by non-financial objectives, which include things like customer satisfaction, employee satisfaction and expectations, management's personal objectives, what the government, society, local community want from the organisation. And we're broadening out there into something known as the balanced scorecard, which is an E3 topic, which is focusing on forward-looking non-financial performance indicators. Now, not-for-profit entities, they can't ignore money entirely because they spend money in pursuit of providing typically a high volume of high quality service of some description. Like imagine a hospital or a school. But its primary objective is not usually to produce money. The secondary objective might include watching how much they spend, but the primary objective is usually non-financial. So primary objective non-financial, secondary objectives, again, all the objectives that support or lead up to that primary objective. Now, fundamentally, if we haven't got a profit motive in a not-for-profit entity, how do we measure how well it's doing? And it's a difficult concept because at least profit is a number, so you can put some effort into measuring your performance there. Now, the National Audit Office in the UK years ago came up with a framework known as the Value for Money framework, which seeks to encapsulate performance in not-for-profit entities. So if you're dealing with a not-for-profit entity, think of value for money, sometimes known as the 3 E's. And the 3 E's are economy, efficiency, and effectiveness. Let's think about what each one of those means. because they all sound a bit similar, don't they, when you first hear them. Economy is the cost of inputs. It's watching how much you spend on things. So if we talk about a school, let's say, economy would be things like the average salary level of the teachers, how much we're spending on stationery and on cleaning and those kinds of things. So that's economy. Efficiency is the ratio of inputs to outputs. So it's how much has come out given what's gone in. So for a school, for example, we might think about class sizes. So relatively large classes are technically efficient because you've got one resource at the front of the room, the tutor, teaching lots and lots and lots of people, in other words, producing lots and lots of educated students. Now, the thing you've got to watch out for with efficiency is you don't push it too far, because if you're overly efficient, in other words, if your class sizes are too big, you end up compromising on effectiveness. And effectiveness is the quality of outputs. So for a school, that might include things like exam results, the employability of graduates, those kinds of things. So value for money is a good word to have in mind here, is about balance. It's about considering those three aspects of performance. So for a school, watching what you spend on teachers' salaries, but not being so tight that you end up with poor quality tutors. Class sizes, you want them to be reasonably large to be efficient, but not so large that you compromise on effectiveness, because at the end of the day you want people to pass their exams and be employable. So that's the value for money framework. Now, there is a little bit more detail in your notes, but essentially that's the bulk of what you need for passing this exam. Now, businesses these days in particular will often consider expanding overseas. And there are many reasons why you might do that: to achieve, for example, economies of scale, or to get closer to your customers, or to diversify and expose yourself to lots of different locations. So if anything happens in any one location, it doesn't matter too much. There might be cheaper resources there, like a lower cost base for labour. So lots and lots of reasons why you might want to go overseas. And ultimately, as far as we're concerned, we'll consider going overseas for a positive NPV if we're in a for-profit business and we're trying to maximise shareholder wealth. It's worth bearing in mind, though, that investing overseas does increase your risk profile in many ways as a business, and I'd refer you to P3 for more detail on that. But we expose ourselves certainly probably to foreign exchange risk if we're buying and selling in overseas currencies, and we're exposed to overseas political regimes which could change, or the legislation that they put in place could change as well. We might be dealing with customers we don't know quite as well. So there's additional risk to consider as well, but that should all be catered for somewhere in your NPV calculation. Now, assumed knowledge for this paper is financial ratios, and calculating basic financial ratios is something you might need to do in the exam to help assess performance. This is partly because objectives are often expressed in terms of financial ratios. So let's have a look, just briefly to recap, on the difference between the various types of ratios. So first of all, we've got gross margin. That's particularly useful for a retailer. Gross profit, which is your sales less your cost of sales. So for a retailer, it's the difference between what they sell stuff for and what they buy it in at. Over revenue times 100 gives you a percentage. Operating margin, similar measure, but taking into account all expenses. Operating profit you would normally have as PBIT, profit before interest and tax. And then you've got your net profit margin, net profit over revenue times 100. So, and that's after tax and interest. So call that PAT. There we are. Generally there, higher is good. Higher means you're getting more profit per pound's worth of cost. EBITDA is an increasingly common measure. EBITDA stands for earnings before interest and tax, depreciation and amortization. So it's before interest, tax, depreciation and amortization. That's particularly useful for businesses that have lots of intangible assets, because if intangible assets are not on the balance sheet, then they won't be subject to depreciation and so on. So using a traditional measure like return on capital employed, which we'll have a look at in a minute, is not quite so useful when a lot of the capital is not actually on the balance sheet in the first place. It's often used as a measure, as a proxy to cash flow, but you need to interpret that with caution, because, for example, EBITDA doesn't take into account money you need to spend to acquire new assets. Very common in the real world is return on capital employed. So we've got operating profit, which is PBIT. We have a capital employed, which can measure either as equity plus long-term debt on the balance sheet, or total assets less current liabilities. And that's going to give you a percentage measure of performance. And again, generally, higher is better there, because if that's higher, then you're getting more profit per pound employed in the business. That can be broken down into two sub-ratios. If you're looking to explain why it might have moved from one year to the next, let's say it's improved from one year to the next, then why might that be? First of all, it could be because your net margin has improved, so you're getting more profit per pound's worth of revenue, or per dollar's worth of revenue, or you're getting more revenue per dollar's worth of capital employed. Now, if you multiply those two ratios together, known as profit margin and asset turnover, then the revenue figures mathematically cancel out, leaving you with return on capital employed. So if return on capital employed improves, that could be because, for example, you've improved your profit margins, so you've got better cost control, for example. Or it could be that you've had a great advertising campaign and you've got more revenue per pound invested coming into the business. If you want to look at things a little bit more specifically from a shareholder's perspective, because that's looking at the whole business capital employed, because we've got shareholders' funds and long-term debt, we can adapt that slightly to include, just to focus it from the shareholder's perspective. And that's return on equity, which is net profit, that's distributable profits. So that's profit after interest and tax and after preference dividends, expressed as a percentage of equity on the balance sheet. So shareholders' funds, that's typically share capital, share premium, and the profit and loss account reserve. And again, higher is typically better there. Debt and gearing ratios. Capital gearing, it tells you how much, financial gearing tells you how much debt you've got in relation to your equity. It can either be done as debt over equity or debt over debt plus equity. I personally think the bottom one makes more sense, because you can interpret it easily, in the sense that if that comes up at 50%, that means half of my finance is debt. If it comes up at 25%, we're saying a quarter of my finance is debt. Now, you've got a question over whether you use market values or book values. Ideally, you should use market values, because that represents the current value of that finance. So that represents how much money is tied up in that finance at the moment. And market value, for example, for shares, is number of shares times share price in there. Now, as to whether that should be high or low, I'll refer you to later in the course when we have a look at capital structure theory. It's a matter of balance. Some debt is good because interest is tax deductible and debt is relatively cheap. Too much, though, and you end up saddling the company with an awful amount of money to have to pay each and every month in terms of interest and capital repayments. Now, debt would typically be after, it would include preference shares as well. I know preference shares, the clue is in the title, they are shares, but they aren't equity shares, and preference shareholders are normally paid a fixed dividend and are paid out in preference to ordinary shareholders. So it feels very much to the company like a form of debt. So that's capital gearing. Interest cover is another important one, and that's how comfortable it is to service your debts. So PBIT is the amount of money you have available to pay your interest out of. So let's say you've got earnings of 10,000, and if you're paying out of that interest of 1,000, then you've got an interest cover of 10 times, which is saying we could have paid our interest 10 times over. And that to me sounds like you could comfortably pay your interest. If that gets close to 1, or heaven forbid even higher, below 1, then you're in trouble because all your money is going to pay your interest. Now, from an investor perspective, the kind of things that shareholders are particularly interested in: earnings per share, which is just distributable profits divided by the number of shares. That's good for looking at trends over time, but you've got to watch out for things like changes in accounting policy, which can affect earnings, which it doesn't reflect any change in the underlying performance of the business. And you can't use it to compare businesses. So if I've got, for example, company A and company B, and the earnings they've got, earnings they've got is, say, 10 each, and the share capital they've each got is $100. But let's suppose that company A's shares are $1 shares in terms of nominal value, and company B's shares are 10 cents shares in terms of nominal value. Then the earnings per share, so company A is going to have 100 shares, so $10 divided by 100 shares is 10 cents a share. But company B, that's going to have 1,000 shares, so it's actually only earning 1 cent per share in terms of earnings per share. So if you compare those two figures, you'd say, oh, company B is doing awful. But it's not, of course. It's performing exactly the same. It's just a function of the number of shares in issue. So you can't really use EPS to compare companies. But yes, trends over time, provided things like your capital structure's not changed very much and your accounting policies haven't changed very much, then fine and fair enough. PE ratio gives you an idea of how the market is feeling about your performance as a business, so and what your future is like. So it's your current price per share over your earnings per share, and generally speaking, high is good there because that's the market saying the future's looking bright for you, so I'm prepared to pay a lot for your share even though your earnings might not be fantastic at the moment. You do sometimes get a blip where earnings per share suddenly dips as a one-off, and if the market accepts that it's a one-off and it doesn't particularly affect share price, then you'll see just mathematically the PE ratio will spike. But that's an anomaly, really. Generally speaking, if your PE ratio is higher than your competitors, that's the market saying to you, you're the winner. Okay, now that's the key ones in terms of investor ratios. There's a couple of others there to remind yourselves of. Dividend cover, perhaps we'll mention in passing, is a bit similar to interest cover, but here we're looking at how easy it was to pay your dividends. So distributable earnings on the top there divided by dividends per share. So earnings per share divided by dividend per share. That tells you how many times over you could have paid this year's dividend. And if that's high, then it means, don't worry, we can pay the same next year, no problem. Now, liquidity, short-term financial health. And the quickest measure of that is the current ratio, which is current assets over current liabilities. Generally speaking, you want that to be greater than 1 because that means you've got enough cash and near cash assets to pay your bills. But you don't want it to be too high. If it's too high, it might suggest you're overstocked. It might suggest you're giving your customers too long to pay, and that costs you. So it's a matter of balance. That sometimes, depending on the industry you're in, it would be silly to rely on inventory as a way of paying your bills, because if inventory is in stock for a long time before it's then sold on credit, and we give customers a decent period of credit, it takes an awful long time sometimes to turn a piece of inventory into cash. So the quick ratio says, look, you can't really rely on inventory to pay your bills, so let's strip it out. The quick ratio is just the same as the current ratio, but we knock inventory out of current assets. Now, if you want to get into the detail of the working capital cycle, you can have a look at the different elements of inventory days, receivables days, and payables days. How many days worth of inventory, how many days worth of sales, and how many days worth of cost of sales have we got sitting on the balance sheet. And if that's stretching out, if we've got more days worth on our overall, then that's suggesting we've got a higher amount of working capital, more money tied up in working capital. Now, as we're producing financial forecasts to state our objectives, it's important for the business itself to understand what things are going to knock us off track. And those variables that we are particularly exposed to, so in other words, a small change in that variable will dramatically affect our performance. We describe ourselves as being sensitive to those variables. So for whatever reason, the business you're in might be very sensitive to changes in interest rates. Let's suppose you've got a lot of debt finance and you've got a lot of customers with a lot of debt finance. So if interest rates go up a bit, your finance costs go up a lot and demand from your customers drops substantially because they can't afford to buy your product. So we describe ourselves there as being sensitive to those variables. More on the calculations on that later on in the course. But for the moment, just be aware that it's useful for a business to be aware of those particular things that will dramatically affect its results. Parity theory, interest rate parity and purchasing power parity can be useful for a business that's looking to invest overseas as a way of, I'm not sure predicting is the right word, but as a way of guesstimating what the exchange rate might be going forward. And the starting point for parity theory really is something known as purchasing power parity. Purchasing power parity, or sometimes known as the law of one price, suggests that price differences between countries should be ironed out through movements in the exchange rate. So if I've got, for example, an exchange rate of $1 to £1, and I've got inflation in the UK is 5%, and inflation in the US is 7%, then per annum, both of those, then over the period of a year, you would expect the exchange rate to move to absorb those differences. So in 1 year, you'd expect, starting off at $1 to the pound, times it by 1 plus the dollar inflation rate over 1 plus the sterling inflation rate. That comes out to be 1.0190, more or less, dollars to the pound in a year. So assuming that economic theory works here, and of course this is subject to an awful lot of short-term speculation and exchange rates flying up and down, but on average you would expect in 12 months the exchange rate to be something along the lines of just over $1 to the pound. And that's suggested by something known as purchasing power parity. Now, an extension of that is interest rate parity. And if you think of interest rates as the price of money, it's just another price. So if that wasn't inflation there, but it was interest rates, you'd do exactly the same calculation, which is what we're saying here in expectations theory. Banks use that concept to give what's known as a forward rate that we'll talk about later on in the course. So if you want to sign a contract today for an exchange of currency at a point in the future, the rate the banks will give you will be calculated using interest rate parity. Same kind of an idea. Okay, now ratios are very limited in usefulness. They make the numbers talk for us, but you have to bear in mind they're calculated in different ways in different businesses. We're only focusing here on financial performance. So you might, for example, have a profitable year, but if you'd lost key customers at the end of the year, staff satisfaction's dipping, and you haven't been innovating and reinvigorating your product range, then in many ways it wasn't good performance for that year. So there are limitations in ratio analysis, and also limitations in using published accounts, because every company has different accounting ratios that can affect the calculations themselves. Okay guys, that's a brief look at objectives in the organisation. The key distinction between for-profit and not-for-profit. For-profit, you've got your traditional ratio analysis to help you formulate your objectives there. Not-for-profits, you've got your value for money, or the 3 E's. What I suggest you do now is have a look at the sort of 5 to 8 questions there are at the bottom of the screen, checking that you've understood this chapter, and then dive into the question bank and get lots and lots of question practice under your belt for chapter 1, and I'll see you back here for chapter 2. In the meantime, thanks for listening.